Hi everyone, this is Tao from ICF 2100. In this video, I will be talking about intragroup sales of inventory in the current year with all transferred inventory still on hand. I am using the example in the textbook. During the current year, parent sold inventory which had previously cost them 8,000 to the subsidiary for 10,000 cash. Our job is to prepare the consolidation worksheet adjustment entry for the year. In order to come up with the consolidation worksheet adjustment entry for the year, I will discuss what the parent and the subsidiary would record in their books, the net effect on the group by simply combining parent's book with subsidiary's book, what should be recorded by the group as a result of the transaction, compare the net effect on the group and what should be recorded by the group, and work out what we have to eliminate, and that would be our consolidation worksheet adjustment entry. Also, we have to consider the tax effect adjustment entry too. In this case, parent sold inventory to subsidiary, so parent will report two entries in their book. The first entry is to recognize the cost of sales at cost, and the second entry is to recognize the sale revenue at the selling price. After inventory was delivered to the subsidiary will record an increase in inventory and an outflow of cash. Remember, the consolidation process, we add whatever recorded by the parent to whatever recorded by the subsidiary and do some adjustment to avoid double counting. So the net effect on group, which is the simple addition of what the parent reported and what the group reported. Parent recorded 8,000 debit to cost of sales. Subsidiary recorded cost of sales. Subsidiary did not report any cost of sales because they are the buyer. Therefore, the net effect on group would be a total debit of 8,000 to cost of sales. Inventory was credited for 8,000 by the parent and debited for 10,000 by the subsidiary. Simply adding them together, we would have a debit of 2,000 to the inventory account as a net effect. Cash was debited for 10,000 by the parent and credited for 10,000 by the subsidiary. They just cancel themselves out, so the net effect is 0 to the cash account. Sales was credited by 10,000 by the parent, and there was no sale recorded by the subsidiary because again they are the buyer. We would have 10,000 on the credit side for sales revenue as a net effect on group. Now, what should be recorded by the group as a result of this intra-group transaction? Nothing, right? Because from the group's point of view, there shouldn't be any transaction. You cannot trade with yourself, you cannot earn profit from yourself. So there would be no cost of sales, no inventory, and no sales should be recorded. Now, we will compare the net effect on group and what should be recorded by the group to see what we have to eliminate in our adjustment entry. First, we have to eliminate the 8,000 debited to cost of sales by crediting cost of sales for 8,000 in our adjustment entry. Second, we have to eliminate the 2,000 debited to inventory by crediting inventory for 2,000 in our adjustment entry. Last one, sales revenue should also be reduced to 0 by debiting sales for 10,000 in our adjustment entry. This is our consolidation worksheet adjustment entry. The 2,000 difference between sales and cost of sales that we eliminated is called unrealized profit. Now, is there any tax effect associated with the elimination? The answer is yes. Because unrealized profit was eliminated, that means we reduce the profit. Income tax expense would also be reduced. Because we earn less, we should pay less tax. Therefore, we would credit income tax expense for 600, assuming the tax rate is 30%. Also, as we credited inventory, which means we reduce the value of the inventory, The carrying amount of the inventory is now 8,000. The tax base is 10,000. So in this case, we have the carrying amount less than the tax base, and therefore would result in a 2,000 deductible temporary difference and a deferred tax asset of 600. In summary, there are 3 steps in preparing adjustment entries for intragroup sales of inventory in the current year when transfer inventory is due on hand. First, we eliminate unrealized profit by debiting sale by the intragroup selling price and crediting cost of sale by the original cost to the seller. Second, we have to reduce inventory by the amount of unrealized profit by crediting inventory for the amount of unrealized profit. And last, the tax effect entry. Thank you for watching.